how to trade the stock market timing like a pro. How to trade the stock market timing like a pro. Good morning, good afternoon, good evening, bonjour, bonsoir, mes amis, guten Morgen, guten Tag, guten Abend. For those of you who are new to us, we are the TSTW 24 traders, and our website is www.stochastic-macd.com. The title of the video is How to Trade the Stock Market Timing Like a Pro. Let's get started. To time the stock market like a pro, professional traders use technical indicators such as the stochastic, the trend line, the channels, and the volume indicators. Traders also use various technical indicators to time the market, but the most popular trading tools are the slow stochastic, the trend line, the channels, and the volume indicator. In this tutorial, I want to talk about the volume indicator as the best timing tool for the stock markets. In order to trade the stock market or to time the stock market like a pro, one must use the volume indicator. I recommend to traders to watch the full length of this video so they may understand how to use the volume indicator to time the stock market like a pro. Alright? First thing first, for traders that are new, what is a trading volume? The trading volume is the total trading activity combining the buy orders and the selling orders. Okay? So when we see the trading volume, okay, we see the trading activity in the market, the number of shares that has been bought, plus the number of shares that has been sold. This is the trading volume. It's all about the trading activity in the market, all right? When we see the red volume bar, it doesn't mean that these are sellers. When we see the green volume bar, it doesn't mean these are buyers. The red volume bar can also represent the buyer, and the green volume bar can also represent the buyer. But understand also that the green volume bar can also represent the sellers, and the red volume bar can also represent the sellers. So the color of the volume bar does not indicate, okay, whether these are buyers or sellers. Very, very important. Now, how do we use, okay, the volume bar to time the stock market, all right? Contrary to the forex market, it is possible for stock traders to use the volume bar in order to understand the trading activity in a specific financial instrument, all right, in a stock market, okay? But the trick that I want to share with traders, I want traders to concentrate on the surge in trading volume, the increase in trading volume. You can see on my chart here that I have put on my chart, okay, some green spots above the volume bar. These are what I call the surge in trading volume. When we have a normal trading volume, okay, a normal trading volume followed by a surge or increase, okay, in trading volume, all right? The surge in trading volume indicates that there is, okay, a higher trading activity in the market, all right? When there is a surge in trading volume, stock traders must pause, must pay attention, all right? The fuel of a trend is the volume, all right? If there is no volume in a trend, the trend will fail. Let me say this to you again. The fuel of a trend is the volume, all right? So for a trend to continue, we must have a sustainable volume, okay? A sustainable trading activity in that stock. So if we have a bullish trend, we must have a significant bullish activity in that stock. If you have a bearish trend, we must have a significant bearish trading activity in that stock. And the surge in trading volume will indicate to us what is taking place in the stock that we are trading, all right? We are looking at the Dow 30 that represents 30 blue chips of American stocks. I'm using Dow Jones because it's one of the best stock market index. Okay, so we have here the volume bar, and I also put on my volume bar the moving average 50. Moving at 50, I'm going to color it now into red so you can see on my volume bar the red line. You see the red line here. This is the moving average 50. Very often you see the surge in trading volume will go above the moving average 50 of the volume bar itself. So let's start now first. Look at this surge here. So we have a normal trading volume and we have boom, abnormal trading volume. Okay, a surge in trading volume, increase in trading activity, increase in the trading volume. How do we use the trading volume to time the market? When we see a surge in trading volume, we know that there is a trading activity taking place. Now, how do we identify that these are buyers or sellers? Very often, you will notice something, that the surge in trading volume will take place around key levels. Do not forget that. Always, when you see a surge in trading volume, it will take place around a key levels. Highlight the point where, see where I put the vertical line. We have a surge in trading volume here. We have also a surge in trading volume here. And we have also a surge in trading volume here. Or you see where I put the vertical line. And these surges are taking place on or near a key levels. All right? When we see a surge in trading volume, the next thing that we need to do in order to time the market is to pay attention to the price. The surge in trading volume will create a validation of a support level or a validation of a resistance level. If we see a surge in trading volume plus a validation of a support level, we must give priority to bullish signal. Let me explain myself to you again. When we have a surge in trading volume, followed by a double bottom chart pattern on a monthly chart. Repeat, for this strategy of how to trade a stock market timing like a pro, one must use the monthly chart and the trading volume on a monthly chart. When we see a surge in trading volume on a monthly chart, followed by a validation of a support level or a double bottom pattern, we must give priority to a bullish signal. Next, if we see a surge in trading volume and a price breaks above a resistance level and finds support, we must give priority to a bullish signal. All right. The opposite is also true in a downtrend. For a bearish market timing. If we see a surge in trading volume and we have a validation of a resistance level or a double top chart pattern, we must give priority to bullish signal. So surge in trading volume will precede the validation of a resistance level or the validation of a support level. So we see the surge in trading volume, then we see a double top chart pattern, or we see a surge in trading volume, then we see the completion of a double bottom chart pattern. If we see a surge in trading volume and the completion of a double top chart pattern, we must give a priority to a bullish signal. But you will see first the surge in trading volume on a monthly chart followed by the validation. Or you may see a surge in trading volume and the price will break below a support level. So we have first, you will notice first the surge in trading volume, and then a few months later you see that the price breaks below a significant support levels. In that case, we must give priority to sell signal. So two things you must understand: a surge in trading volume, a validation of support or resistance level, or a support being broken, or a resistance being broken. If we see a surge in trading volume and we follow by a validation of a support level or a double bottom pattern, priority to bullish signal. If we see a surge in trading volume and the price finally breaks above a significant resistance level, we must give priority to bullish signal. If we see a surge in trading volume and we see a validation of resistance level or a double top chart pattern, we must give priority to bearish signal. If we see a surge in trading volume followed by a price breaking below a support level, we must give priority to a bearish signal. There are more to this, but I don't want the video to be too long, and I don't want it to be too complicated to new traders or beginners traders, okay? So for the advanced traders, there are other examples. We see a surge in trading volume and a completion of an earlier wave pattern, okay? Or we see a surge in trading volume followed straight away by the completion of a Fibonacci pattern. So in that case, you see the surge volume at the point where the earlier wave pattern is being completed, or at the point where the Fibonacci pattern is being completed. Okay, now for the Dow Jones Index, talking about stocks, okay, how to trade stock market, timing like a pro in order to time the market. It's not sufficient, okay, to identify the trade setup. So what is the trade setup in this case? The trade setup is, for instance, okay, a surge in trading volume plus a double bottom chart pattern. This is a trade setup. When we identify the trade setup is not finished, we must now use a top-down trading method. So on a monthly chart like this, you will see a surge in trading volume followed by a double bottom pattern. This is a bullish trade setup. I must now use a top-down trading method or a multiple time frame trading method, okay, to optimize my market timing. All right. So talking about a multiple time frame trading method or a top-down trading method. Here we are on a monthly chart. We'll use the monthly chart, daily chart, and hourly chart. So the monthly chart will give us the trading setup. The daily chart will give us the signal, and the hourly chart will give us the entry point. For the entry point, we can go down again from the hourly chart, down all the way to the 1 minute chart if you want to, okay, pinpoint the best place to enter the trade or the best place to buy the stock, the best place to sell the stock, or the best place to exit the trade. Talking about market timing, we are talking about buying at the right time at the right place, selling at the right time at the right place, okay, or exiting the trade at the right time and at the right place. We can combine, okay, as I explained to you, the surge in trading volume will always, most of the time, will always take place around key levels. Why? Because if the big institution want to buy, they will buy at a specific price. If they want to sell, they will sell at a specific price. All right? So we can combine, okay, this technique with key levels. As I explained to you, the surge in trading volume, that's why if you are looking at the trading volume, I prefer that you pay attention to the surge in trading volume, because the surge in trading volume will regularly take place on near a key levels. Professional, big institution, hedge funds will buy or sell around key levels at a specific price. So another thing that we need to understand, talking about market timing, stock market timing, is that, okay, the surge in trading volume, okay, reveals to us, okay, the hidden activity of the smart traders. All right. So the smart traders, hedge fund, mutual fund, hedge funds, okay, banks, big financial institutions do not show their traces on in the market. They do not reveal the activity in the market. They want to hide it. Okay? Using black pools, they want to hide their buy orders, their sell orders. They don't want the general public to know that they are busy selling a stock, they are busy buying a stock. So they would use black pools to hide their trading activities. But the trading volume can, if we understand how to analyze the trading volume, we can clearly see that the big banks, the big financial institutions are buying or are selling or are exiting their trade. Okay? So apart from the volume indicator, as I explained to you already, some traders use the stochastic indicator, the trend line, the channels. But for stock trading, for the stock market, I highly recommend to traders to use the volume indicator, especially the surge in trading volume. So looking at the Dow Jones Index on the monthly chart, I recommend to traders to use also the monthly chart. Okay, so you can see that I highlighted some of the surge in trading volume here with the green spot on my chart. So let's look at the first one here. So this is a surge in trading volume. So the red one first, followed by the green one, the all surge in trading volume. They will happen around key level. So you see on the monthly chart, switch your time frame to the yearly chart to see whether this is taking place around key levels. I know this is a key level because I have those lines on my chart already. 8285, these are key level for the Dow Jones. 11999, key level for Dow Jones. 15551, key level for Dow Jones. Okay, another one here, 18954, another key level for Dow Jones. Another one, 17292, key level for Dow Jones. Surge in trading volume will often take place around key level. So look at the first one here. So the surge in trading volume, pay attention to the red one, that went above the horizontal blue line here. So a surge, increase in normal trading volume. This is the surge here. Okay? So pay attention. What has happened after that? Remember what I said? There was a surge in trading volume followed by what? A double bottom pattern. We will give priority to bullish a signal, yes or no? So the surge in trading volume happens first, and then we have what? A validation of support level or a double bottom pattern. What do we need to do? We must give priority to buying orders. Okay? So if you do that here, a surge in trading volume followed by a double bottom pattern, price break above the nut. The nut is this point here, above this resistance here. Priority to bullish signal, and as you can see, in fact, you will check also how much they have bought. You're on a monthly chart. If you look here, they have bought nearly 7.3 billion share, 7.3 billion trading activity. Beautiful, it's a huge. So we know that the fuel of a trend is what? The trading volume. So if we see a surge in trading volume, like we see here, more than 7 billion transactions taking place, all right? Now we see a validation of a support level, price breaks above the nut. We know that there is a high chance that a trend will remain in place for a long period of time because this is a huge trading activity, followed by validation of support level. The nut is broken, and now we know that there is a high chance that this trend may last. So there is a pattern that we follow. You will see sometime for traders that understand Elliott wave, we have a trend, 1, 2, 3, 4, 5 waves, followed by a correction. And then we have a surge in trading volume, signaling to us that there is again another bullish, okay, trade that is about to begin, or a bearish trade that is about to begin. So multi-wave, correction, surge in trading volume, validation of support level, and then we have a new trend. So we may have a bearish trend first. So previously, we may have a bearish trend followed by a surge in trading volume. After the surge in trading volume, we have a validation of a support level or the price breaking above the previous resistance level. We will give priority to bullish signal, indicating to us there is a high chance, not certainty, because the global economy can change at any time, but all we can say at this point in time, it's not guaranteed that there will be a trend, but there is a high chance that there will be a change if the market environment is suitable for us. All right. So here, this is one example here: a surge in trading volume, okay, followed by a double bottom pattern. High chance that we may have a trend. It's not guaranteed that we will have a trend. Okay, we have a double bottom pattern. The nut is broken. Not only that we have a surge followed by another surge again. And then we have a double bottom pattern, and the nut is broken, and the trend has begun. The trend has started in 2003, has lasted, okay, up to 2007. Before that, we had a correction. So you see here, there was a trend, a correction, and a surge in trading volume. Talking about traders that understand the Elliott wave pattern. 1, 2, 3, 4, 5, followed by a correction. A pattern is completed, and we have a surge in trading volume and a validation of a support level. Okay? Let's look at this one here, the second one here. I don't want the video to be too long, you see here. So we have volume almost here. And then suddenly we have this, you see, a surge. It went above the horizontal line. Boom, boom, boom. It's a surge. So here, this is the vertical line. Pay attention to this vertical line. So this time, all we do, when we see a surge in trading volume, we don't assume that it's going to go up and go down. We just observe the price. If it is bullish, resistance will be broken. If it's bearish, support will be broken. Or we may see a bullish pattern or a bearish pattern. So here we see a surge where I put the vertical line. I'm here now. And look what has happened after that. We have a resistance being broken. A price break above the previous resistance. So the surge has taken place here. Price went down a bit, but no support was broken. Are you with me? So we are looking for support to be broken or resistance to be broken. So price went down a bit. It went down a bit to retest. In fact, it went down to retest the previous high. It's bullish. So it went down, price, it was surging trade volume, price went up to retest the previous high, and then went up again to break above the resistance at the top here. Is it going up or is it going down? How do you know? The price will tell you. Follow the price. If it's going up, it will be in a rising channel. It will be displaying higher lows and higher high, and resistance will be broken. So surge in trading volume, price break above the resistance, priority to bullish signal, a surge in trading volume, price form plus a double bottom pattern, priority to bullish signal. Here again, these are buyers. Okay, you will also look back, look on your left hand side. What has happened before? We have a bearish, we have a trend and a correction and a surge in trading volume, and then a trend has begun. Okay, price went up a bit, and then it's consolidation. It's consolidating. It's a continuation. Surge in trading volume, price went up, it's consolidating. There are more to come. Resistance broken, another surge in trading volume. Here it is, priority to bullish signal, and it went up again. Okay? The third one here, pay attention carefully. We are talking about how to trade stocks, market, timing like a pro. Okay? All right? Using, the trading volume. All right? So we are looking at the Dow Jones on the monthly chart. I recommend to traders to use the monthly chart, okay, and to pay attention to the surge in trading volume. Here we have a surge in trading volume. Great. This is draw a vertical line at the point where you have the surge in trading volume. This will allow you to time the market correctly. Remember, the surge in trading volume plus the trade setup, plus a validation of support or resistance level. This is the trading setup. Do not forget that we are on a monthly chart. Therefore, we must use a top-down trading method. We can apply this strategy on a weekly chart, monthly chart, yearly chart, and daily chart. But I recommend that trader use it on a monthly chart. If one wants to catch, if you're an investor, you want to time the market, you want to buy at the right time and the right place, you want to sell at the right time and the right place, you want to exit the trade at the right time and the right place. Use the trading volume on a monthly chart for accurate market timing. Okay. So here we have another one. This is the third one. Here we have a surge in trading volume. Okay. What do? We pay attention to the price. If it's bullish, resistance will be broken. If it's bearish, support will be broken. So after the surge in trading volume, what do we have? We have a resistance that is broken. Which one? You see the resistance here? On our left hand side is resistance here. The horizontal line. Price went above it. Now after this, the third one here is surge in trading volume. Price finally break below that, okay. This is a key level, break below the key level, okay. So this resistance has become a support, break below it. And now it retests it here. We'll time the market right here. So a surge in trading volume. A key level is broken, price break below a key level, and retest the key levels. Break below and retest, and then we will use a top-down trading method. Monthly chart, daily chart, okay, hourly chart, because you're on a monthly chart. If you were on a daily chart for day trading purposes, we can use daily chart, hourly chart, 10-minute chart. Multiple time frame trading after a surge in trading volume on the edge, okay, right here. You see how we can time the market? So with this information, we know that these are sellers. After this candle here, you see this month here, this candle is closed. Because we're on a monthly chart, the monthly candle that is closing below the key level must close fast. So if this candle is not yet closed, do not assume that it's yet finished. So the candle must close fast. Let me say this again. That candle on that time frame must close first. The candle that breaks below the key level must close first. If you're on a daily chart, it must close first on a daily chart. And the next candle must start. If you're on a weekly chart, that candle must close first. I'm repeating this because it's so important. If you're on a monthly chart, it must close first. If you're on a quarterly chart, that quarterly candle must close first and must close below this key level. Because you're on a monthly chart, this monthly candle must close first. So I'm not selling. If I'm on a monthly chart, using a monthly chart as my setup time frame, I cannot sell yet until this candle is closed below this support level. If I'm on a weekly chart, that weekly candle must close first. Forgive me for repeating this because it is so important. That's why I'm stressing on it. Okay. So this, by using the surge in trading volume and paying attention to the price break below a key level, retesting the key level, now we have a beautiful bearish trend setup. This is how one can use the volume indicator to time the stock market like a pro. Okay, now let's pay attention. So here you were buying before, so the price was going up, going up, going up. Suppose you didn't know what's going on. Suddenly you see this surge now. So a surge will tell us there will be a change or a continuation. So if we were buyers before and we see a new surge, so we bought it here, okay, it breaks the bow, we buy it here. Now we see a new surge. It's alerting us that there is a high chance that the market may change direction. If you like, you may take some profits. So by using the surge in trading volume, you can also exit the trade. So I buy it here after this surge. Now suddenly I see a new surge here. I may decide to bank my profit. Okay? Now, and wait for what's going to happen next because I don't know what's going to happen next. All I know is that there is a surge in trading volume, a surge in trading activity, so I can exit my previous trade. So here a buyer may exit the trade and wait. If there will be a continuation, resistance will be broken again, and one can re-enter the trade, okay, and buy again for the second time. But here, after exiting the trade, if you exit here, you will notice quickly after this candle closed below, see, it didn't go above the previous resistance, so we can confirm after this surge, it didn't break any resistance. We didn't see any double bottom chart pattern. Okay, you may see, this low here, and this low is, a valid support level. Okay, so if you say this low and this low here is a double bottom pattern, the knot is here must be broken, and the knot was not broken. The double bottom and the double top, the knot must be broken first to confirm, that it's going to go up or go down. All right, this is about double top and double bottom trading, okay? So pay attention to the fourth one here. This is the fourth one here. Here we are again, that surge in trading volume, this one. Are you with me? Am I talking to myself? Let's zoom into this one here. This is the one we are talking about now, okay? So again, right here, if I move my vertical line to that point in time, that's it exactly there. That's where we have a surge in trading volume. Okay, look what's happened. This is a support zone, the horizontal line, okay? But below that support zone, that's where we see a surge in trading volume. But the price break below that support level, after you see the surge happen first, and then the price break below it. So you can sell again. But because you are selling, you don't want to sell on or near a support level. Okay? So unless it breaks below the support level and it's retesting the support level. But because we are selling here, after we see a surge, and the price dip below the orange line here, we are selling, but there is another support very close to us. So we need to manage the trade carefully. Remember, in order to time the market, we can use an exiting trading strategy. So you sell at a resistance level, or you sell below a support level and take profit at the next support level. Okay? So if you are selling here, our first target is the first and nearest support level, which is very close. So you see here the price found support. But let's concentrate on this one. There was a surge, price break the first support level. Situation is a little bit bearish, but because there is another support very close, we may decide to stay out because there's not much room for the price to go far, or we may decide to swing trade or to day trade instead. taking it bit by bit. And finally, the price found its support, okay, at the next support level. But look carefully. We are again here, the fourth one. The price, there was a surge. Look, we have also a completion of which pattern? A double bottom pattern. This low here and this low. Price changing direction. In fact, we have a triple bottom. This low, and this low. We have a surge in trading volume followed by a triple bottom pattern. We give priority to bullish signal if the knot is broken. But look, where is the knot? It's not here. We may say this is the knot, but there's a knot here, this double bottom that was here. This one. Above that high will be more profitable, will be more, okay, easier to buy above this high here because there was a double bottom here, the knot is this one here, and the price retesting the same low, forming a triple bottom. So it will make sense to consider this knot here. So a surge in trading volume and the price form a triple bottom pattern and also the knot is broken. What do? We pay priority to bullish signal. Price going up, we must exit the trade on or near the next resistance level, okay, to manage the trade. We don't want the video to be too long, and I hope you are learning something from this video. Let's continue. The last one here, you can this one here, we have again a surge in trading volume. All we do next, we just pay attention to the price. What's happening next? Is a resistance being broken? Is it a validation of support level? Is it a validation of resistance level? Is a resistance being broken? This will tell us whether these are buyers or sellers. Okay? There was a surge here, which is the vertical line here, and the price pulled back to form what? A double bottom pattern. Which one? This one. A double bottom pattern. But again, always look on your left-hand side. What has happened before? The price went up, okay, and then pulled back to form a double bottom pattern. So this point, in fact, is a cycle point. Traders that are following I know that this is a cycle point. 180 degree. Return back to the starting point. The trend has begun here. Return to the starting point. There's a high chance that a new trend may begin. But we see a surge in trading volume here, which is the fourth one, followed by another one that is taller. You see this one? The second one, very tall. Very tall. Surge in trading volume. At that point, so there was a surge first, followed by another bigger surge. And the price forming a triple bottom pattern. Now we look on our left-hand side, we see what has happened before, and the knot is broken, and now the price going up. So 1-2 surge, huge surge after a downtrend. So you see, there was a price was going down from 2008. This is the financial crisis, 2008 to 2009. Now we have suddenly this surge plus this surge. The first one here is telling us to get out of the trade and to sell because the resistance here is broken. You see how one can use, okay, the volume indicator to trade the stock market timing like a pro. So this one is telling us to exit our bullish trade. This trend has begun in 2003, coming to the end. This one is telling us that, okay, be careful. There's another surge. So if you were selling after this support is broken, we must exit our trade. So exiting, best exiting is about best timing, best buying time, the best place to buy, best place to sell. Okay, it's all about market timing. So this surge, the fourth one is telling us to exit our bearish trade after the price dip below the support level. It's also alerting us to be ready that the price may change direction, followed by another surge again. Now we see that we have a triple bottom pattern and the price forming again, breaking the knot. And there's a high chance that after, okay, a trend, remember earlier we traded, bullish trend, multi-wave, correction, forming 180 degree, okay, a surge in trading volume occurring at the point of the cycle point, alerting that there's a change about to take place. We keep our eyes on the price break the resistance level, price validate the support level, there is a validation of support level, we give priority to bullish signal. If there is a validation of resistance level, we give priority to bearish signal. Here, we have a typical pattern, a bullish multi-wave, followed by a correction and a surge in trading volume. And the knot also is formed, is broken, and probably forming a triple bottom pattern. is likely to go up. If you pay attention to this one again, this one here, we see this one here, there's another surge. So price was going up, okay? If you didn't come out before the surge, okay, you should come out because there was a surge, we have a trend that was going on. Another surge, be careful, you can bank your profit or secure your gain. Anytime you see a surge in trading volume, it's alerting that there is a high chance that we may see a continuation or a change of the trend or a reversal. Keep eyes on the price. If a resistance are broken or we see a validation of support level, we'll use a top-down trading method, repeat, a top-down trading method, all right, to optimize our market timing, okay? The multiple time frame trading allows traders to time the market more accurately using various time frames. Okay, now we have, you see, look carefully to the horizontal line that are drawn here. So we have normal volume and a little bit of surge here. Is it going to go down or go up? Tell me now. Are you sure? Is it going up? Is it going down? Okay. If you didn't get it right, the correct answer is this. So far, we can't tell because this support level at 155.51 for the Dow Jones is not yet broken. If, for instance, this on a monthly chart, a monthly candle closed completely below the level of 155.51, then we will wait for the price to retest the level of 155.51 to give her the best place to sell the Dow Jones index. But that support level, that key level, 155.51, is still in place, which is a support level. So it's a little bit of surge. I'm not convinced that these are sellers. What we will prefer, so to look into the future, we will prefer a surge of trading volume that is almost equal to the previous surge here, this one here. So we will prefer another surge that will bring the price, the trading volume in a zone of $6 billion, 6 billion transactions. Are you with me? So I'm not accepting this as a sellers here, okay, though this, okay, this candle is not yet completed. The price is still above the resistance level, so above the support level, so the price is not breaking above the previous high, which is this resistance here, and it's not dipping below, it's not yet below the level of 155.51. So we cannot tell yet that this is buyer, these are buyers or sellers. But if this candle closed below this level, we will wait for a rally to retest at the level of 155.51, and then we'll use a top-down trading method to optimize our market timing. Remember, for the multiple time frame trading method, if the signal fails, we will close the trade. So it's about the setup, the signal, and the best entry point for the perfect or profitable or the most optimized, timing place, But if the signal fell, talking about the multiple time frame trading method, we must come out of the trade completely. But at this point in time, as we are now today, is the 6th of September 2015, here in London, we can see that I will prefer myself, that if we want to see a surge, we want to see a surge that is almost equal to the previous surge here, and the price to dip below, to close below the level of 155.51 on the monthly chart. A monthly candle must close below the level of 155.51. So far, we cannot tell what is likely to take place because the price did not break as the previous high and did not break this support level. We do not have also a bearish a double top or a double bottom pattern. We will see here. Will it form a double bottom here? We will see. But it's not changing direction here so far. It didn't change direction yet. So we will have a double bottom on the level of 155.51. We will see. So all we can do at this point in time is to draw a small channel like this and leave it on our chart. Will it come up this bearish small channel, to form a double bottom here? That remains to be seen, As I said to traders, we'll wait up to July 2016, and the market will show us clearly what is likely to take place. And I would prefer a surge that is almost equal to the previous surge in the zone of 6 billion, okay, trading transaction. So there's a high chance probably that the price may form a kind of a double bottom here and go up a bit, okay, to reach, okay, July 2016. That would remain to be seen. This is just a speculation from my side, and we'll see what's going to happen. So far, we cannot confirm that these are buyers and sellers. This is about, okay, how to trade the stock market timing like a pro. To summarize this video to traders, the market timing involves, okay, buying at the right time and the right place. Okay, it's also about selling stocks at the right time and the right place. But it is also about exiting, okay, a bullish trade or a bearish trade at the right time and the right place. Professional traders use various technical indicators such as the stochastic, the trend line, the channels, and the volume indicator. For the purpose of this tutorial, we were using the volume indicator to demonstrate to traders how one can time the stock market like a pro using, okay, the volume indicator. Okay. First thing first, we are looking for a surge in trading volume, a surge that is above a normal trading volume. As I show you here, I draw the horizontal line on my volume bar. I'll also use the moving average 50, and we want a surge, a significant rise in the trading volume. This will take place very often around key levels, because professional always will trade around key levels. Okay. When we see a surge in trading volume, we are now paying attention to the price. We are looking for a validation of support level or a double bottom chart pattern or a resistance being broken. In that case, we'll give priority to bullish signal using a top-down trading method. If we have a surge in trading volume and we have a validation of resistance level and a support is broken, we'll give priority to bearish signal. We can use the surge in trading volume to exit the trade. So we have first a surge in trading volume. If we have another surge in trading volume after that, we may decide to bank our profit. If a continuation is taking place, we will have another chance to re-enter the trade in the same direction. If a reversal is taking place, then we will enter the trade in the opposite side. It makes sense? It is also powerful. Remember, by using a top-down trading method, okay, we will optimize our stock market timing. The surge in trading volume and the validation of support and resistance level, or the violation of a support and resistance level, allow us to identify the trade setup. So this is the beginning of the market timing. Surge in trading volume, validation of support or resistance level, or violation of a resistance or a support level. This is the beginning of market timing. If we have a confirmation, we must now use a top-down trading method to optimize our stock market timing. As I explained to you, traders use various technical tools to time the market, but the best technical tool for stock market timing is the volume indicators. We are the TSTW24 traders talking about how to trade the stock market timing like a pro. I hope you have learned something from the video and will put it into use to make excellent market timing decisions. This video is suitable for day traders, swing traders, and investors. As always, one must test or retest, okay, this strategy without using real money. Use a demo account. Practice will make you a better trader. If you like this video, okay, please give us the thumbs up. If you dislike it, make sure you give us the thumbs down, but put a comment below why you disagree with us. If you have any question or any comment, or we have missed something, we have not discussed something, or you want to add something useful, please put in the comment section. All right. If you truly like this video, feel free to share it on Google+, on Twitter, and also on Facebook. All right. If you love our videos, feel free to subscribe to our channel. We are the TSTW24 traders talking about how to trade stock market timing like a pro. Until the next time, enjoy yourself and be very happy. Speak to you soon.